now let's unpack some of the top economic stories on the data front, from money supply data to PMS pump price and what's playing out at the oil market so far. Joining me now is Dumebi Luwale. She's the manager, financial derivatives company. Joining me right here in the studio. Good to have you.
Thank you for having me.
Dumebi, yeah. So, looking at some of the data out recently, that was yesterday from the CBN, money supply.
Yes.
That's been high for the longest time, but now we're seeing January data month on month. Has come down.
Yeah.
How significant is this contraction for January?
I think it did come down, but I guess the more important thing is the growth rate in the money supply, and of course how the drivers, of course, of the numbers that we're seeing. I think that in itself is what helps us to really understand the magnitude of what exactly is going on and the potential impact on the broader economy. So you're very right in that money supply has been high, and that has been because of legacy issues that contributed to that. When we look at the Naira redesign period, how that there was still old cash in circulation, and then we had new cash that met up with that, and then we didn't exactly mop up all of that excess liquidity that was in the system, and afterwards we also saw some level of cash hoarding at some point within the Nigerian money market system, and of course also the period of increased money market liquidity. All of that put together, of course, has contributed to the rise in money supply growth, and especially cash in circulation. But we're seeing all of these things beginning to somewhat adjust and change under the new regime of the central bank system, and of course the increase in channels for moving money around. For instance, with the latest NIPS data, we saw that POS transactions significantly increased. That tells us that
that's been on an uptrend.
That's been on an upward trend over the last couple of years, and we're also seeing those other e-channels bump up. So what that is telling us is that while cash in circulation has been high, we're also seeing as well an increase in movement of money across other e-payment channels. So I've mentioned the drivers of what has brought us to where we are today, and now talking about where we're going to. So in January, of course, we did see somewhat of a slowdown, which was primarily driven by the lull in economic activities. If you even think about it, between myself and you, how much did you really spend in January compared to December, right? So that shows us how exactly and why those numbers soften. Now going into the remaining part of the year, we do expect that consumption activities, business activities will pick up. So we might see money supply levels probably pick up a little bit, especially with the fact that interest rates have now been cut, but not by so much really, because we do expect the central bank to keep monitoring money market liquidity. But essentially with the money supply growth story right now, the implication of the slowdown in growth compared to last year or even last 2 years, it means that the impact of money supply, that is money moving towards inflationary impact, is now beginning to subside. Right, it's beginning to subside, and we expect that trend to continue as the central bank continues to manage liquidity.
Right, because it's quite interesting. When I remember the chart, you're comparing MPR and inflation trend. In 2025, we did see inflation trending downward. The MPR stayed stable.
Yes.
At 27.5 most of 2025.
Yes.
Then we had that one cut, then a hold again. So it's been tight monetary policy.
It has been quite restrictive.
And looking at 2026, now we're seeing, we had the first cut, in 2026. So I'm wondering if the easing, continues. Is there a risk that that could, put more money, in the system, increase money supply, going forward?
I mean, so let's start with the situation around the interest rates movement. I genuinely don't think that the central bank would maintain so much of an easing cycle when you consider the fact that
when you just see what's playing out in Iran.
Exactly. So when you see all of that and the implication of that on domestic commodities market, you know that there is a likelihood of inflationary pressures to significantly increase, because now it's not only going to impact oil price, but also it's impacting other commodities that we still import, and that means that prices of those commodities are likely to increase if this war sustains, or it even gets more aggressive, right? And by aggressive I mean the involvement of other countries, because right now it's a trifecta: the US, Israel, Iran. But the UK is also beginning to, have some conversations around this. And if the UK gets involved, the chances are that some other Middle Eastern states as well would likely get involved. And then before you know, I mean, right now there are conversations
like central bank heads are sitting right now and they're nervous,
thinking about
just wondering, okay,
what step can we take?
What next?
And the idea, of course, is to remember that the single most important role of the central bank is price stability on the exchange rate front and on the inflation front, right? And the tools at their disposal to ensure that this happens is primarily interest rates, right? So interest rates with the hope that it cascades to other forms of interest rates, across the economy. Then you also have other, liquidity tightening measures like OMO and all of that. But primarily the interest rate, the MPR, is the anchor rate that does more signaling. It anchors on forward guidance, and more importantly, it determines the flow of how interest rates are going to change. But speaking to your question specifically on how that move would likely impact money supply growth, the thing is, number one, I don't think that the Central Bank of Nigeria is going to consistently cut rates. Is there the possibility of another rate cut in sight? As of when we had the February meeting, there was. But right now, when you see all of the factors that are at play and how they would likely impact inflation in the economy, the chances are that the Central Bank would maintain its restrictive stance, where it would not likely cut rates any further and just continually watch, continually watch how the global macroeconomy continues to shape and how geopolitics continues to affect global commodity price, and that impacting on the broader macroeconomy. The second thing to also note is that we've had a lot of methodological changes with our inflation basket, and the central bank is not aloof of those changes, because to some extent, while domestic commodity prices have declined between October and December, or even January 2026, the reality is that we're not yet where we were before, where consumers are still feeling the pinch on their pockets. While consumption is likely to pick up, it's not exactly to increase rapidly. And the goal of the central bank is to ensure that that happens. And the only way that would happen is if prices consistently fall, based on a realistic level where myself and you can take 1,000 naira and we buy 1,000 naira goods worth, right? Even at 15%. For an emerging market, inflation is still relatively high. There are central bank reports that have shown us that there's a threshold for inflation and how growth retarding that would be. And the growth aspect that they're significantly talking about is on the consumption part of the growth equation, where it said inflation at 12% is growth retarding, is growth restrictive. And by the growth, again, like I mentioned, the growth aspect that they're talking about here is on the consumption level. Consumption in itself contributes over 60% to Nigeria's GDP. So if consumption in itself is weak, it means that the GDP numbers would likely are also going to continually remain weak.
What we're trying to aim for about 7 to 10%.
Yeah, 7 to 10
growth.
10% growth. Right?
It's quite interesting. You hear some countries either meeting their inflation target,
yes,
or actually getting into single-digit levels. After being in double-digit for the longest time.
Yes.
But when you go into the markets, you're speaking to households. There's still an affordability issue, even though the data, is looking pretty good.
Yeah.
But let's flip over now to another issue that's looking at oil prices. Fantastic, for government revenue, for oil producers, but not great when you go to the pumps. And looking at oil now, it's quite volatile.
Yeah.
At this point, we're hearing calls for maybe a $90 per barrel level.
Yeah.
And definitely we're already seeing increases, at the pump. So help us marry this, at this point. I know some of these refiners, they still have $60 oil.
Yes.
I think, but they've already bumped up prices.
I mean, this is what happens in primarily like developing markets, right? Prices are sticky downward. It's something that we typically expect. Even though these commodities are bought in forward contracts, right? The likelihood of prices changing very quickly, right, when it's going up is almost always very high and almost always very certain. But one thing that we have seen, at least with the Dangote refinery, is that even though prices are likely to change, they don't change by as much as the prices actually on a global scale increase. So even if right now we've seen like an increase in the pump price, it is most definitely not by far how much prices have increased on the global scale. We've seen all prices touch almost $80 per barrel within the last how many days, because this attack actually happened in the last week of February. We're just in the first week of March. Prices have jumped by over 10-20%, but we haven't seen pump prices significantly increase by that much, right? The thing is, with this kind of price changes, the thing is, we see importers actually adjust their prices to meet up with the next batch of products they're going to buy. So they're able to generate as much they're going to actually buy, so there's less of a supply constraint where they now have to charge almost at market rate, right? So on the consumer level, of course, it definitely calls for some guidance on more consumer protection, just to somewhat ensure that there's no form of price gouging and extreme case of price discrimination across the different markets. But one thing I can assure you is that pump prices are going to increase as long as this war escalates, as long as this war remains in place. The other thing to also note is that there will be price changes, differentiation across different markets based upon logistical issues. So a market like Lagos might have a lower pump price compared to states maybe in the south or southeast. But I think the more important thing to note here is that if we do produce more, we're able to actually generate more, and the chances are that that could somewhat help to some extent on the supply side. And here is what I mean. If we're able to meet up with the cotton, right, our refineries, our other modular refineries are also doing their own bit to ensure that they're able to, meet up with production and also supply, not necessarily relying so much on Dangote refinery to meet up demand across the whole 36 states in Nigeria. Expectation is that if the NNPC is able to provide, the raw material to these refineries, including the Dangote refinery, what it means that their cost of actually acquiring from the global market is lesser. And if that is lesser, it means that their cost of actually producing might just be more contained to regional and domestic factors. Doesn't mean that they would not still experience some other international factors, because for instance the NNPC might not be able to provide for all of them, right? But if that supply is consistent enough for them to refine, it means that they most likely be able to supply Nigeria, and that would help to keep prices either where they are, or if they're going to increase, they would happen at a gradual level, not at a level that's
not as big as the oil swings that we see in the global market.
Exactly.
All right, we'll keep watching.
Yes.
Hopefully, I don't know, I just feel it at some point, the bears will resurface, in the oil market, and, they'll come and, drag those prices down, but we'll see. De-escalation, de-escalation. We're hoping for de-escalation. Yes. Thank you so much, Dumebi Oluwole, she's manager of Financial Derivatives Company. Thank you for coming on today.
Thank you for having me.
All right, I'll take a break now. When we come back, we look at what's playing out in the travel industry, how it's the war impacting all of that. That's next. Just stay with us.